Welcome back to Factful Finance, your trusted source for all things personal finance. Let me start by asking you this. What would you do if you suddenly lost your job and had no income coming in? How would you keep up with your mortgage payments? It's a tough question, and for many, it can be a terrifying situation. But did you know there are options that can help you through a time like this? Today, we're diving deep into the world of mortgage forbearance during unemployment. How it works, who qualifies, and the steps you need to take to protect your home. But before we go any further, a quick note. This video is for educational purposes only. The information we provide here isn't meant to be financial advice, and you should always consult a professional for guidance tailored to your personal situation. Now, let's jump right in. Losing your job is never easy, and in some cases, it can happen out of the blue. Whether it's due to an economic downturn, company layoffs, or any other unforeseen circumstance, unemployment can quickly lead to financial uncertainty. One of the biggest concerns people face is keeping up with their mortgage payments. If you're unable to make payments, falling behind could risk foreclosure. But don't panic. There's a program that exists specifically for situations like these, and it's called mortgage forbearance. Here's what mortgage forbearance means in simple terms. It's a temporary agreement between you and your lender that allows you to pause or reduce your mortgage payments for a set period of time. During this time, the lender agrees not to start foreclosure proceedings, and it gives you the breathing room you need to get back on your feet. Now let's break down the key points. 1. Eligibility for forbearance. Generally, to qualify for mortgage forbearance during unemployment, you'll need to prove that you're experiencing financial hardship. This can include job loss, illness, or other unexpected events. You'll also need to show that you're unable to make your mortgage payments because of that hardship. It's important to remember that lenders have different criteria for approval, so you'll need to contact your lender directly to discuss your specific situation. Number 2, how long does forbearance last? The length of time you can take advantage of forbearance varies depending on your lender and the type of loan you have. Typically, forbearance lasts anywhere from 3 to 6 months, but some programs can extend that period even longer. It's crucial to communicate with your lender and find out exactly how long your forbearance agreement will last. 3. What happens after forbearance ends? Once your forbearance period is over, the next step is important. You'll need to work out a plan with your lender to either pay back the missed payments or extend the repayment period. In some cases, you may be able to add the missed payments to the back end of your loan, or the payments may be spread out over a few months. But you should never assume that forbearance means you're off the hook for your payments. It's essential to work out a plan to get back on track. Let's look at a real-world scenario. Meet Oliver, a graphic designer who lost his job during the pandemic. With no income coming in, he found himself falling behind on his mortgage payments. Fortunately, Oliver had a government-backed loan, so he was able to apply for forbearance. His lender agreed to pause his payments for 6 months. During that time, Oliver worked hard to find a new job and ultimately secured one with a higher salary. By the time his forbearance period ended, he was financially stable again and could resume his payments without any issues. For others, however, the situation may not be as straightforward. Mia, a single mother, found herself in a similar situation but faced a challenge when her forbearance period ended. The catch? Mia didn't know how to handle the missed payments once the pause ended. She wasn't sure if she should catch up on the missed payments in a lump sum or ask for a new forbearance period. After reaching out to her lender, she was able to set up a payment plan that worked for her, allowing her to pay the missed amount over several months. So if you're in a position like Mia or Oliver, here's what you need to keep in mind. Proactive communication. Always stay in touch with your lender. They'll often work with you if they know you're trying to resolve your financial issues. Review your options. Ask about any available loan modifications or repayment plans. Sometimes there are alternatives to forbearance that may be better suited to your situation. Seek professional help. If you're unsure about the best course of action, consider consulting a housing counselor or financial advisor. They can help you understand your rights and options. According to the Consumer Financial Protection Bureau, around 10% of homeowners who entered mortgage forbearance programs due to the pandemic have since fallen behind on their repayment plans. This shows that while forbearance is a great tool, it's not a permanent solution. You need to make sure you're actively planning your next steps when the forbearance period ends. If there's one takeaway from this video, it's that mortgage forbearance is a tool, not a free pass. It's a way to help you stay afloat during tough times, but it's not a long-term fix. The goal is to use that time to rebuild your finances and make a solid plan for the future. Before we wrap up, let me ask you, what's the first thing you'll do if you find yourself needing mortgage forbearance? Drop your thoughts in the comments below. And if you found this video helpful, why not hit that subscribe button so you don't miss out on more expert insights like these? We think you'll find our next video useful for your financial goals too. Thanks for watching Factful Finance, and we'll see you in the next video. Remember, we're all about providing information so you can take control of your financial future.